All right, guys. So this afternoon we're going to be talking about market structure. I just truly believe this is one of the most important aspects of trading. Once you understand the way that the market moves, then it makes your life much simpler when it comes to trading, right? It's going to help you to understand, of course, the direction of the market, but not only the direction of the market, but also when to enter and exit the market as well, right? Every strategy, right, all starts with the structure of the market. If you've got this understood, it will make things much easier for you. So when we're talking about the market structure, when we're talking about the structure of the market, there's three ways the market moves, or three directions rather that the market moves. It moves up, it moves down, and it moves sideways, right? An uptrend, also known as a bullish market, also known as a buy in the market. A downtrend, right? A downtrend, also known as a sell in the market, also known as a bearish market, right? And sideways, meaning that the market is just consolidating. It's neither creating highs or lows. The market is just going sideways, right? So examples of this, when we're looking at an uptrend, right? An uptrend, for it to be a valid uptrend, it is made up of higher highs and higher lows. Okay, it is made up of a series of higher highs and higher lows. Now, at the very beginning, when I heard that, that was complicated. I didn't understand what it meant. Right, it was new for me, so I'm going to break it down, make it very simple. Okay, so right here in the market, this is considered to be a low, right? Then this peak right here would be then considered to be a high. Okay, so we've got a low, we've got a high. Okay, we got a low, we got a high. Now, this point right here would create a higher low. Okay, so this point is higher than this low, but it's still considered to be a low. So we call this a higher low, right? Then this peak here came up higher than this previous high. So we call this a higher high. Okay, then of course, this becomes your higher low. Then we have a higher high. Then we have a higher low. We have a higher high. Then we have a higher low, right? And then we have a higher high. So the market, it is seen to be in a valid uptrend, right? When we have a series of higher highs and higher lows. So that's how you'll know whether the market is actually going up or not. If you're not seeing higher highs and higher lows, then we can't really say, okay, well, yeah, it's an uptrend. Okay, we can't really say that the market is going up. So once we see these things happening, once we see the higher highs and higher lows being created, then you have a great idea that, okay, this is what's going on in the markets. Okay, so that is an uptrend. Yeah, that's how we identify an uptrend. Now, let's look at a downtrend. Now, a downtrend is made up of lower lows and lower highs, right? So let's do the same thing. This is considered then to be a high in the market. Okay, this was your high, and then this became your low. Right? At this point now was lower than this previous high. So we have a lower high being created. And then here we have a lower low. All right, so this low is lower than this low. So we created a lower low. Then we have a lower high. And we have a lower low, a lower high, and a lower low. Okay, very simple stuff. Yeah, but I'm telling you, once you get this, it'll change everything for you with your trading. All right, then we have a sideways market, or what we know what is known to be a consolidation in the market. These are made up of equal lows and equal highs, right? Or relatively equal lows or relatively equal highs, because sometimes it may not be, like so equal, right? But it's a relatively equal low, right? And equal highs. Yeah. So this is how you would know that the market is consolidating or moving sideways, or also known as ranging. Okay. This is how you know, okay, the market is going sideways. There's no clear direction of if the market is going up or if the market is going down. Okay, so that's the basis of market structure. Okay, that's the basis of market structure. Now, there's another aspect to it that we want to identify. This aspect now is going to help you to identify where do I actually want to be buying and where do I actually want to be selling in the market, right? Now, if I'm in an uptrend, the best place for me to buy is at the higher lows, right? I want to be buying right here, okay? Very simply, you've probably heard this before, buy low and sell high, okay? Same thing with trading. You want to buy as low as possible, okay? We want to buy at these higher lows. You want to buy at the high, you want to buy as low as possible in the market, okay? And then we want to sell. So if you're in a downtrend, we want to sell as high as possible. Okay, so we are selling at lower highs. Okay, you're selling at lower highs. You're selling at lower highs. Okay, that's how we want to look at the market. You want to buy as low as possible, sell as high as possible. So that even if the market is ranging, okay, you want to buy as low as possible and you want to sell as high as. Okay, so that's how you start to look at the markets now. Okay, how is this useful to me? Right, it's useful to me because when I look at an uptrend, I want to make sure I'm buying at the higher lows and not buying at higher heights. Okay, you don't want to enter the market at this point, right? So why do we want to buy at higher lows? Right? And why do we want to sell at higher heights? Simply put, it's going to one, increase your reward, right? And reduce your risk, right? Remember, trading is all about risk versus reward, okay? So it's going to reduce your risk when you buy as low as possible, and it's going to increase your potential, for reward, your potential for profit, when you buy low. The same thing on the selling end. It increases your uh, profit, increases your reward, and it reduces your risk. Okay, because when we look at this, guys, remember, remember this when you're trading. Okay, at any point when you are buying, all right, let's put this here. Okay, at any point when you are buying, right, you want to buy at discount. Okay, you want to buy at discounted prices. Remember, we're buying as low as possible, right? You want to buy wholesale. Okay, it's trading is business as well. You want to buy at discounted prices and you want to sell at premium prices. Okay, you want to buy at discounted prices and you want to sell at premium prices. So what is discount, right? Let's make this make sense. So this is an upward trend. This is the market going up. All right. So this was our move up. All right. This is the market pushing upward. Okay. Now we want to know, okay, I want to buy at a discount price. What is discount? Discount is considered to be, guys, below 50%. Yeah, below 50%. When you go, you have a sale, there's a sale at a particular store, it's really only a deal. It's really only a discount if you're getting 50% or more off, right? Same thing with your trading. You're looking at discounted prices being below 50%. Okay. So from here or lower, right, would be considered to be discount. Okay. This would be considered to be discount, right? And above this area would then of course be seen as premium. Okay. Remember, we don't ever want to buy in premium prices. We want to always buy at discounted prices. Okay. So above 50%, this is your premium price. Okay. So once again, I'm going to repeat it. We always want to buy at discounted prices and sell in premium prices. So you're looking for buys, we buy at discount. Okay. We're looking for sells, right? Same thing applies. So market kind of came down, came back up like this, and then it pushes down. Boom, right? We want to know, okay, 50%. Okay. So here, once again, this is premium. Okay. This is premium. Okay. And then down here, all right, so right here, which is 100% of the move. So from here to here was 100% of the move, right? You want to find that 50% area, all right? So then here becomes discount prices, okay? So I hope that makes sense, okay? So whenever you're looking at the markets now, we see, okay, this is discount, this is premium. You see, this is discount, this is premium. We want to sell here, all right? We want to sell in these areas, right? Remember, sell at premium, buy at discount, okay? Hope that's making sense to you guys. All right, so when we are looking at these markets, we're still on market structure, right? We're still on market structure. I'm going to remove everything here. Okay, I'm going to remove everything here. All right. So when we are on market structure, always remember that when the market is buying, we always do three things. All right. Number one, get an impulse. Okay, we get an impulse. Number two, we get a pullback, also known as a correction or retracement. And then number three, we get a continuation. Yeah. So we get an impulse, we get a correction or a pullback. All right. And then we get a continuation. Okay. So get impulse, we get a correction. Oops. All right. Are also known as a pullback, right? When they use the word pullback, all mean the same thing, guys. So impulse, a pullback, the market just pulls back, all right? Similar to like a slingshot, all right? Gains some momentum, and then boom, pushes up again. And that's where we get that continuation, all right? All right, so we got an impulse, we got a pullback, and we got a continuation. This is how the market will always move. It doesn't matter, right? What you're looking at. I mean, it's not going to be this perfect, but this is how the market will always move. At no point are you going to just see market do like this, all right? Or market just drop down like this, all right? Anytime a market does this, it's usually followed by something looking like this, okay, before it continues, right? Before it continues to go up, okay? It gains momentum or what is called liquidity in the market before it continues to push up. And why is this, right? I like to make things make sense, make things very, very simple. Simply because the market is made up of buyers and sellers, okay? The market is made up of buyers and is made up of sellers. We can't have buyers if there are no sellers. Think about it. All right, think about it. We can't have sellers if there are no buyers. All right. So the market is always aiming, all right? The market is always aiming to rebalance itself. Yeah, it has to be balanced. The market is always aiming to rebalance itself. So if I have a case where I just have a major impulse to the upside where I just have buyers, then I need to balance, the market needs to balance back out and have sellers in the market, right? Same thing, right? With if the market just goes down like this, we just have an impulse with price going down, market needs to balance out and have buyers in the market as well. Okay, so this is why we always see this type of movement where price is up, comes back down, then we continue to go up, right? Then price comes down, back up, and then we continue to go down, right? Because the market has to rebalance itself. Okay. Now, hope everybody's paying attention. This is making sense to you, right? Now we're gonna look at, okay, now where exactly am I looking to buy and to sell? All right. I know I said it to you guys, you buy at higher lows, you sell at lower highs. All right, but let's bring it all together here now. All right, let's bring it all together. All right. Typically, when we are looking at the markets, typically when we are looking at the markets based on the time frames that you're looking at, the bigger time frames is going to look like this, right? Similar to this one right here. It's going to look like this, where price comes up, comes back down, right? And then continues to go up, similar to this, yeah? So taking this into consideration, right? Here's what will happen. So when we look at the market, they would see this. And then the question always comes, well, how do I actually know like where the higher low is, right? How do I know that the higher low wasn't here, or maybe it wasn't here, or maybe it wasn't here, right? How do I know that that higher low is actually going to be here, all right? And I'm so glad you asked that question, because here is what typically happens, right? You do an analysis of the market on the higher time frame, right? But you enter on the lower time frames. So for example, you do analysis on the 4-hour time frame, maybe the 1-hour time frame, the daily time frame, anything like that. But then you want to enter the market on the 15-minute, the 5-minute, and then maybe even the 1-minute time frame is where you actually enter the markets, all right? So this right here is, let's say this, you're on a, let's say this is the 4-hour time frame like we actually are on here, okay, boom. And this was your risk, and this is your potential, second, guys. This is your potential return right here, okay? So this is your risk, this is your return. Now, then the advantage of entering on a smaller time frame is that you get to reduce your risk. You actually see what is happening in this area right here. All right, remember, we're using this as the example. Okay, you actually get to see what is happening in this area right here. I'm going to make it make sense for all of you. Okay. So this is your risk, this is your return. When you enter on smaller time frames, then it makes it a lot more precise, your entry that is, right? And you reduce your risk, increase your reward even further on a smaller time frame entry. So on a smaller time frame, what does this, or this rather, right, actually look like? So smaller time frames, this is what is actually going to look like, right? So we see the market going up like this, right? Let's just put it like this. You see the market coming up like this, then the pullback is looking like this. All right, the pullback is looking like this. All right, where it's not just one move down, you might see something looking like this. All right. All right. This is what the pullback actually looks like. Right? That's what the pullback actually looks like. Not just one move down, like you guys would have seen, like there's up and down movements in here, right? This is what it would look like on a smaller time frame. Okay. So, all right, smaller time frame, because you can see all of these movements, right? Because you can see all this on a smaller time frame. Now it's you have the ability now to get a little bit more precise with where you actually enter the market. Okay, so there's a number of ways, of course, that we could actually enter, right? You like I call, there's the first to the party entry model. And what does that simply mean? It means there's those individuals that they're always first to the party, right? And like they're the persons that as soon as price reaches this particular area, right, that we're looking to buy in, they enter the market immediately, right? Like their entry is here, boom, they are in for the buys. Okay. Then there's that person where I call second to the party, right? Or where the entry now basically has a bit more confirmations before they actually, decide to buy or sell in the market. I'm going to show you what I mean, right? So you see in the same type of stuff happening, right? See the same type of things happening, right? The same markets pulling back, etc. But this person, though, they're not entering at this point. They're waiting for confirmations now for us to say, well, yes, price is moving from going down to actually going back up by creating a high, right? And creating a higher low. Okay, so we're looking for what is called a break of structures. Price was coming down. We need something to indicate what, yeah, we're changing direction before we actually decide to buy. Here, right, this individual is entering on, like I mentioned, the first move, right? This individual is entering on the first move, right? Which is entering as soon as the market reaches here, boom, they execute their order, they're in the market. Whereas we are looking for, right? We're looking here at the second entry, neither is wrong, just this one has more confirmation. Whereas you're looking for price to break this structure, say to us, okay, well, great, boom, we created a high, right? This was our low. We're now creating a higher high, which is confirming, right, the shift in the market. And then we actually enter the market at this particular point right here. All right. We actually enter the markets at this particular point, and it also reduces our risk, right? Where now we can have a stop loss that is like right about here, right? So like I said, neither is wrong. It just provides more of a confirmation, right, for you to actually enter the market, right? So I hope, this quick lesson on market structure helped you guys significantly. We could actually take it to the actual chart here to show you, exactly like what it was saying. All right, let's do that for the next few minutes, and let's break it down further. Right, so let's say if you're on a 4-hour time frame, we want to come down on a smaller time frame perspective. Okay, let's go to, all right. Okay, we're breaking it down. Smaller time frame perspective. You're on the 4-hour time frame, right? Let's say you were looking for price to come into this particular area here for a buy, right? Let's take a look at it. Okay. So we're looking for price to come back down. Remember, we want to buy as low as possible, right? So let's say we were looking for examples, guys. We're looking for price to trade back in to the imbalance that was created down here. Okay. We're looking for price to trade back into the imbalance that was created down here. And this was our first entry into the market. Yeah, this was our first entry into the market right here. Boom. Soon as price came there, we decided that we are going to enter. Okay, so this is entry model 1, like I would have mentioned. Okay, this is entry model 1, where we actually grab the entry right here. Okay. Entry model 2, we're waiting for confirmations. Okay, let's see if we can go this far back. So we go to a smaller time frame entry. Okay, let's get it. Let's get this far back. Hopefully we can. Okay. Oh, okay, perfect. All right. All right, let's in. All right. Now we are looking for, all right, the second entry in the market, right? More of a confirmation that price is going to push up, right? So like here, for example, price came down, came up here. We created here, we created a lower height into the market, right? Created a lower height in the market, right? Price did not break this low. Then we came up, created a height in the market, right? Created a high here in the market, right? Price traded back in, filled in some imbalance and so forth that was created, right? Not to use terms that you guys may not be familiar with, but this would then become entry model 2, where we have more of a confirmation of price then going to the upside. So then your entry moves from here, right? It's a little bit later for sure, to then here, right? And then this becomes your risk. Okay, that becomes your risk in the market, right? So neither is wrong. Like I mentioned, this model requires more patience, number one, and two requires more confirmation in the actual market, right, before you decide to hop in. All right. So I hope this lesson made sense to you guys on market structure. Want to keep it very, very simple, right? Hope that again, it just makes a ton of sense for you, and you go over this and implement it to your trading. All right. Look out for another video as it relates to structure, and then as we get into entry models into entries. All right. Have a great one, guys. Be blessed. I'll see you guys on the next session.